had a mainframe. For the first time, we could actually manipulate life insurance policy illustrations. And we created Pay For, Pay No More. And that was pay for premiums, borrow the rest. And again, we're normally talking about whole life. So borrow the rest of the premiums, and then also borrow interest. And this became the rage of illustrations. I was working for a mutual company at the time, and 40% of our new sales were Pay For, Pay No More. So, and we were not unique in that regard. We then went from that, we went to the personal computer, able to generate these illustrations individually. And it obviously caught the attention of the Internal Revenue Service. And we then come down to 1986 with the major rewriting of the Internal Revenue Code. And the interest deduction for life insurance was on the line. Now, first thing that happened, obviously, was that the 86 Act denied all interest for personal interest. But when it came to business interest, and I'll tell the story, this is August of 1986, August 16th, and I was working with people in the industry, and I called our representative in Washington and said, "How's the interest deduction look?" And he said, "No problems. Senator Dole's on board." He was then leader of the Senate. And he said he's on board. We're going to have the interest deduction for business-owned life insurance. Have a good weekend. And it happened to be a beautiful weekend. And I'm a morning person. So on Monday morning, I go to my office early. I like to read. And back in those days, if you had a message waiting for you on the office phone, there was a red light that blinked. I picked up the message, and the message was all is lost. Senator Dole sold us out. So we basically lost the interest deduction for business, except for an amount of $50,000 per insured, and obviously that was a piddling amount. The industry had developed a lot of so-called COLI type plans, and this was working with businesses from, Fortune 500 to corner Main Street type businesses, and everything became a turmoil. The response was a number of marketers said, well, okay, we'll take advantage of the 50,000 limitation, and we'll put life insurance on every employee. This led to what was known as janitor insurance, a great deal of consternation that many employees didn't even know that their employer had insurance on their lives. Again, I was still working for that same company that I mentioned, and I had janitor insurance on me because every employee had insurance. So in '96, we came out with the Pension Production Act, and Congress did a couple of things. One is they said, employer-based insurance, you had Code Section 101J, and you had to have notice and consent. They also limited, in terms of the $50,000 limitation, that if you weren't a key employee, one of the top 5 individuals or 20% owner, you were treated as one person for the 50,000 limitation. This led to an ongoing concern with the IRS in terms of a number of things. One, which was a point that the industry kept emphasizing, is the life insurance paid out more benefits each year than the Social Security Administration. and the insurance was not a bad thing, it was actually a good thing, and that the $50,000 limitation didn't make any sense. Could we handle this in a different way? So we had, I guess, our fourth different attempt to get at the problem of business financed insurance. And what Congress came up with was a provision that said, with regards to a business owning cash value life insurance, the interest deduction, in other words, take the whole corporate interest deduction for everything, okay? And this could be for, a mortgage on buying property, or, buying equipment, and, deducting it on a finance basis, et cetera. But you take the whole slew of the interest deduction and you minimize it, or you subtract from it a fraction equal to the cash value of all life insurance policies over total assets of the business. And then you would apply that to the interest deduction, and you'd reduce it by whatever that fraction came out. However, after a lot of hard negotiations, the industry was able to put in an exception. And the exception is actually bigger than the provision. And what it says is, if the insurance is on a 20% owner, or an officer director, or the big one, an employee of the business, then that limitation didn't apply. And so we have had, since that point in time, a situation where essentially only either officers, directors, or employees are insured. Part of our organization, and Jordan and I work for the same division of Lincoln, but we're a major player in COLI in terms of executive benefits, and the market has been great. Again, we really don't have to worry about the interest deduction in finance COLI, because again, we're only insuring officers, directors, or employees. So essentially now we don't have any limitation if a business borrows to pay premiums on a policy that it owns, as long as the insured is an officer, director, or employee. It is an ordinary and necessary expense, and the interest is deductible. And that leads to a brief discussion I want to make of a case that Mike and I and Jordan worked on. Michelle worked on it as well, in terms of what we're looking at in terms of combining premium financing with split dollar. And so we have a lender. The lender makes a loan of the premiums to a corporation. And the corporation is going to pay interest back to the lender. In the policy, which is a permanent policy and has cash value, is collateral for the loan. Okay, nothing exciting here. This is just traditional straight premium financing. Now, where it changes, and this doesn't affect the premium financing, is we do endorsement split dollar. So let's say the insurance is on an owner or a key employee, and we enter into an endorsement split dollar arrangement. And under endorsement split dollar since 2003, the corporation owns the total cash value in the policy. And this is good. It's good because it's an asset on the books. So we're creating an asset on the books equal to cash value. We can use the cash value. The business can use it for any purpose it wants. We do see it being used for deferred comp and salary continuation, that it can be distributed from the business to the employee as deferred comp. It's a good deal for the business, because if they make withdrawals down to basis or loans thereafter, that's tax-free, but when they pay out the deferred comp benefit, they get a deduction. So it's kind of a free deduction for them. With regards to the net death benefit, and this is the death benefit over the total cash value, under the split dollar agreement, that's owned by the employee. and the employee has to have W-2 income as compensation based on term rates. So we apply a term rate to the net death benefit, and that's additional W-2 income. The rules with regards to the term rates are you have your choice. You can use Table 2001, which is a series of term rates promulgated by the IRS. Or if the insurer has alternate term rates, which are lower, you can use the alternate term rates. Lincoln does have alternate term rates. So normally we're talking about the alternate term rates. Generally, the employee is going to turn around and assign the net death benefit to an island. The reason for that is to keep the net death benefit out of his or her estate. One of the good things about split dollar is for income purposes, we use term rates, but for the gift, we also use term rates. And this goes way back to an old IRS revenue ruling in 1979. So one of the good things is that if you have a large policy and maybe you have a problem with gifting into the trust, the gift is based on the lower term rates. It's not based on the premium. So that was the arrangement. It's straightforward. It's just a combination of premium financing and split dollar. Simple, easy to understand. Employees like it. And of course, there's a lot of leverage because and again, in this situation, we're dealing with the owner of the business, and he loved the idea that in essence, he was getting insurance based on term rates with all this leverage created through the financing, and that the corporation was not taking a hit on the books in terms of premiums being non-deductible expenses, that it owned the cash value. So with that, I think we're going to Michelle next. And Michelle is going to talk about how Lincoln does premium financing. And we are a major player, so it's a very nice story.
Thank you.
And I'm going to stop sharing.
Okay. And I'm going to
Thank
try
you, Tom. I just want to say, let's hold, questions. We can post them in the chat box and we'll get to everything. There's going to be some time at the end I know there's going to be a lot of questions. So I know I have a bunch. So we'll.
Okay, so I think everyone can see my screen.
Yep.
Good deal. Again, thank you all. Thank you, Tom, for kicking it over to me. And thanks everyone for spending some time with us here this morning. I am Michelle Solosi, Premium Finance Consultant on Lincoln's Specialty Markets team. And today I'd like to just take a moment to talk about how premium financing is a significant sales opportunity. Who's utilizing this funding solution and why it's even more appealing in today's low interest rate environment. Then quickly look at our illustration software and some of the flexibility that we have within our product and the design. So again, as Neil just mentioned, questions will be held for the Q&A session at the end. But while I'm talking, maybe think about some clients that you have that could benefit from this funding solution. It could be, current clients that have in-force business that could benefit from financing their in-force business, or clients that could benefit, need coverage, need business insurance, and would be better off financially by not liquidating their assets. So why is premium financing a significant opportunity? Not only do these cases tend to be significant in size, as a matter of fact, the average PAP or paid annual premium on these cases, what we pay out on is around $400,000 to $450,000 on average per case. So not only are they, significantly large in size, but most cases that start off as being premium financed end up being self-financed cases. But by presenting the funding solution, it gives your clients options and it makes it more likely that either way it goes, you get the sale. Nothing's worse than having a case go almost all the way to the finish line. Someone comes along and brings premium financing to the table. Your client likes the idea and they end up going with that guy and finance their case elsewhere. But if you're the one that's presenting it, either way, if they like it, they're still doing the business with you. If they decide they don't like that solution, they're still doing the business with you. So now let's take a look at what exactly premium financing is, just to make sure we're all on the same page. It's just, as the name implies, it's borrowing money from a third party. You think of, financing a car, and you're using those funds to pay premiums on life insurance policy. So as you see here, the client's going to borrow, the trust is going to borrow from a lender. They're going to make the premiums. The lender's actually going to send Lincoln the payments, and the client is going to pay interest on the loan. They're not going to give the money to us for free. And while we say that we would like to see interest paid annually or even more frequently, Lincoln does allow some clients to accrue some of that interest. They would have to have 10 million in net worth and be a US citizen, and they could only accrue for a max of 10 years. So again, as long as the bank is okay with that, we will allow some accrual of interest, but for the most part, we assume interest is going to be paid annually. In addition to paying the bank interest, the bank's also going to require collateral to be posted for the money that they're borrowing. A lot of individuals or individuals that I work with say, I'm working with a high net worth client. We don't need to utilize any type of high early cash value rider to collateralize this loan. They have enough outside assets. Well, 68% of the cases that we placed in 2020 utilized a high early cash value rider, one of the riders that Lincoln offers. And we'll get into more detail there on those riders in a moment. But it is something that, is clearly sometimes needed. So while not all clients prefer to utilize a high early cash value rider, just keep in mind that Lincoln does have some high early cash value riders that could help offset that collateral if needed. Eventually, the loan is going to be repaid. Most often, we're going to see this from a distribution from policy values. And then once that policy is, the loan is repaid, benefit is the client's free to do what they want. And most of the time, it's going to go to the beneficiary or the trust in the end, or the business. So, why would people choose to finance? Clearly right now, they're wanting to take advantage of low borrowing cost. This time last year, I thought we couldn't get any lower. LIBOR, the rate at which lenders base their benchmark for lending their funds was at 2%. Currently, the last I checked, LIBOR was at under 50 basis points, about 35 basis points. Now, a lot of lenders are going to set a floor on that. They don't want to go below LIBOR, but we can look around and I can help in those discussions as well. There are some banks that will lend at LIBOR, but for the most part, I'm seeing people putting a floor on it because it is so low of about 1%. So on top of that LIBOR rate, you're going to see a spread based on the amount that you borrowed, and we'll get into that in a second as well. But clearly, low interest rates not only attractive for borrowing for life insurance, but for many other reasons as well. So you're seeing a lot of people right now refinancing and looking at even, again, their in-force business and possibly looking at financing that as well. These individuals could be illiquid. Their money is tied up in real estate and they can't readily access their wealth to pay premiums. If they did access this money, it could trigger a large capital gains tax. Or they may just simply want to conserve their gifting capacity. So these are just some of the reasons why individuals would choose to borrow money versus paying out of pocket. And then, what does the typical client look like, or what is their need? We just recently, heard Tom speak about the election yesterday and things changing with estate tax. But estate planning has always been historically a traditional reason why people would premium finance. Their money is tied up. They're looking at a large estate tax consequence, and obviously putting in, insurance in place is going to help when they pass. Their beneficiaries pay off that tax for them. And now with it, sunsetting, we're looking at a larger group of people being exposed to that estate tax consequence. Clearly, what we're talking about today is the need for business insurance. So a lot of people can take advantage of financing, getting some of that interest deducted. And it's, a very prevalent reason for individuals and businesses to look to financing to help pay for those premiums. And then lastly, what has picked up more traction lately is the retirement income need. We've seen a trend over the past several years of the age of these individuals trending down. In 2019, average age was around 59, 55. 2020, average age was closer to 50. So these people aren't buying it necessarily for that estate planning need, more business insurance need. And also with that is that supplemental retirement income. So again, these are people that want to diversify their retirement portfolios, and insurance is a terrific way to do that. So, we've discussed the low borrowing cost, not wanting to liquidate their own assets, avoiding capital gains tax, and, conserving some gifting capacity. So we see a lot of the benefits in this solution, but we would be remiss not to mention some of the risks that are associated with it as well. Not only me mentioning it to you all, but if you are presenting this, you would want to make sure that you're also presenting your client with the risk associated with it. Clearly, there's interest rate risk. I mean, if interest rates start to go up, that loan interest that they're planning on paying is going to increase. We would think that invertly, that if interest rates are going up, that we're earning more on the policy. So, while you might be coming out more, you're earning more. There could be additional collateral requirements. If the policy isn't earning as expected, and we thought that we were going to be able to utilize some of those funds within the policy, maybe they're not there, and maybe they're having to come out of pocket more or post more outside assets for collateral. Maybe we were only planning on taking a loan for a term of 5 years. We get to the 5th year and we realize our policy isn't funded appropriately. We might look at taking out or renewing our loan for a longer period of time. I've never seen the last 2 bullets occur, lender insolvency or defaulting on the loan. We do have a lot of parameters in place that we hope help avoid those situations. We're only going to accept certain lenders in these arrangements. So typically we're not going to see that, but could it happen? Sure. And then, speaking on lenders, as far as lenders go, Lincoln does not actually endorse or approve the lender. What we're looking at is the premium finance arrangement. We're looking at these on a case-by-case basis, and that's what we're underwriting as the actual loan terms. But as part of the process, we are going to possibly reach out to these lenders, get some loan docs, and look at their collateral assignments if they don't want to use ours. But for the most part, if the loan terms are coming from one of the top 200 US banks with no regulatory issues, they're fine. And if they've done business with us in the past, then they're presumed to be fine as well, as long as nothing has changed with regulatory issues. And then, we mentioned the low borrowing cost and mentioned the LIBOR rate. Again, last year, 2%, currently, or as of December 31st, 0.35. This is just an example of what it looks like when you take that benchmark LIBOR rate and apply a spread to it. I will say that I tend to design a little more conservatively. I'd rather have people anticipate coming out of pocket to pay interest a little bit more than what they actually will probably get. So, when we're looking at anyone that's paying premiums or borrowing premiums from 100,000 to 499,000, that spread is, 250,000 or 250 basis points that I'm going to apply to that. I honestly think the spread is closer to 225. I think I've just increased each one of these by 25 bips. So again, you borrow more, you get a break. Some people want to borrow all of their premiums up front so that they can get a better break, better spread on the monies borrowed. But clearly, people are presumed to be earning double digits on their assets where it's invested in their brokerage account. So, would they benefit from not liquidating, taking a hit on that money, and simply borrowing from a bank and paying, anywhere from 2.5% to 3% on the funds versus taking the hit on their assets? And the answer is yes. Again, along with the interest that's going to be paid to the bank, we are expecting collateral to be posted, not us as in Lincoln. We are going to ask what collateral is being used, but the bank is going to need collateral posted. Again, as I mentioned, a lot of individuals think that if they're dealing with high net worth individuals, they're fine. They don't need to utilize a higher cash value rider, but that is sometimes in the 11th hour exactly what's needed. We're reworking the design and putting a high early cash value rider on that so we can close the loan docs, because there was a problem with getting the money ready at time of loan execution. So it is something Lincoln has, keep that in mind. But some of the possible premium finance collateral is going to be policy values, not only by putting a rider on it, but do they have any current in force cash value life insurance? Anything with cash value could be used to post as collateral. Obviously, liquid assets, the more liquid, the better. And then marketable securities, you're not going to get 100% of what you have in the security. I would say, close to 50% of the market value is what you're typically going to see given for collateral purposes on marketable securities. Again, this is going to vary between lenders, but for the most part, this is the most common types of collateral you'll see posted. And then, just quickly looking at what we saw last year, this is me. The final numbers haven't come out, but I have a pretty good idea of where we're landing in 2020. Again, that age went down. We're looking at 50-year-old male, small business owner or professionals. We do offer our fixed products, but for the most part, they're going to utilize our IUL because of that cash value that product offers. The average face size is around 10 million. You're going to see the death benefit increasing for a number of years up front, then leveling off later. We're max funding this, so getting as close to the MEC limit as possible. We're looking at paying premiums for 10 to 12 years. So, where most loan terms are 5, we are going to see a lot of those renew for an additional 5 to 7 years thereafter. And again, we've reviewed the why. They're looking for estate planning, and the owners can vary between an actual individual, a trust, or a business. Just quickly looking at the high early cash value riders that we offer, Lincoln has what was formerly known as the exec rider, is now referred to as the lever. This option can significantly minimize the out-of-pocket collateral. It gives you an option of either 100%, 93, or 85% in cash surrender value equal to premiums paid. So if you elect the 100% option, for the first 7 years, your cash surrender value will equal premiums paid at 100%. All right, so essentially, all your out of pocket in that scenario is the interest that you've paid into the policy. If you want to walk away in the first 7 years, the bank will be repaid in full by you surrendering the policy. And then we also have this fee, which is our surrender value enhancement endorsement. This is basically going to permanently waive all surrender charges. This one has a little less drag on the policy. Clearly, if we're bolstering cash values up front, you can anticipate some drag on the policy values on the back end. This fee is going to help minimize that a little bit. But those are two of the higher the cash value options that we offer at Lincoln, very popular. And then just some things I wanted to point out before we move over to looking at our illustration software. These are guideline differentiators, things that I see that really help us get some of these cases to Lincoln. The first is our net worth and income. We have one of the lowest net worth requirements for the younger aged clients. So if you are 50 and below, we only require a net worth of 2.5 million. Most are going to start at 5 million. We don't require 5 unless you're 51 or older. Annual income is 250 for all age groups, but we do have the ability at underwriter's discretion to look at the income and net worth on an either or basis. So let's say I'm a young, what we call in the industry, high earner who is not rich yet, a Henry. I've got a very large income, but maybe my net worth isn't at the 2.5. So I'm making 800,000 and I have a net worth of 1.8. Our underwriter can approve that even though both net worth and income aren't met. We can look at it on an either or basis. So that's been a big win for Lincoln. Again, the interest accrual, we do want to see interest being paid, but will consider those that have 10 million in net worth, US citizen, and are only accruing for a period of 10 years. But that is something that Lincoln offers as well. And then lastly, we allow foreign nationals wealthy global clients to finance their Lincoln policies. Of course, we're going to need a US lender to be utilized. And they also need to exhibit 10 million in verifiable net worth to be considered for financing, but not a lot of carriers offer that. So been a huge one for us for the past year and a half. And then just my team. So while I exit this and pull up, you can still see my software, right? Okay.
Yep.
So
Yeah.
just wanted to quickly look at our illustration software. This is actually showing you the finance wrapper essentially on the policy. I can click into here. So instead of just your regular ledger, what you would get if you were just running a normal quote, we can actually add on a premium finance wrapper that's going to show you, what the loan looks like applied to those funds. So in this case, we're just borrowing for the first 10 years, 437,000. I've used a varied loan rate starting at 3.35. Again, that's very conservative. I know Neil can get much better rates than I can. So again, would rather show higher than lower. You can see basically over here under the cumulative net outlay column, this is what they've paid in interest. We get down to year 15 before we roll out of the loan. They've paid a little over 1.9 million in interest, assuming they've paid interest all years. And under the cash surrender value, you'll see in these parentheses, negative number, this is the anticipated collateral that they would have to post outside of the policy. So in this case, I've not utilized any high early cash value rider. Then quickly, I will flip it over to a design that does utilize a high early cash value rider to kind of show the difference here. Again, if we're bolstering cash values up front, more than likely we're going to have some drag on the back end or not have enough funds as early on to roll out of the loan. In that case, the first design we were rolling out in year 16, and this design I had to push it out one additional year. But you'll see here under the cash surrender value where we did see negative numbers, now we see a 0. This is because this policy is fully collateralizing the loan. So at any point in the first 7 years that they wanted to walk away from the arrangement, the bank would be paid back 100% of monies borrowed, and the client would be out at that point $421,000 that they've paid in interest. So just, keep in mind that we do have this ability. I know there's a lot of groups out there, third parties that have their own software that they can utilize. Lincoln does have that also. Myself, my partner, and our case designer are happy to run some quotes for you. Again, this is a fixed product, but it is also flexible. So, we're max funding it. So we won't be able to get necessarily more money in, but we could reduce it at any point in time. If they wanted to borrow less, we could look at reducing down the death benefit and then look at potentially putting in less premium, whatever the need for the client. This is flexible. We can kind of change it along the way. So with that, that's really what I wanted to share as to the premium financing portion. So I will stop sharing and we'll let Jordan take over.
Thank you,
Perfect.
Michelle.
Thanks, Michelle. Can you guys hear me okay?
Yep.
Yes.
Great. Well, good morning to everybody. Thanks for hopping on. As Mike mentioned, I'm Jordan Walker. I head up both the Business Insurance Solutions department here at Lincoln, as well as our Life Comp TPA, essentially, that does a lot of administration on the back end of complex business insurance cases and a little bit of estate planning cases as well. So I'm the go-to resource at Lincoln, as well as my team, to get any case design work done, case consultation done, just basic getting the case across the line. You can lean on us in the business market. I figured what we could do is go through an actual case that we're working on that deals specifically with financing and with some of the things that Tom talked about. I want to talk a little bit about the endorsement split dollar piece as well. To kind of tee this up, one of the reasons, or I'll say it this way, a couple of the things that we're seeing right now in the current environment, we'll define current environment as COVID environment and also potential estate tax change now. is that business owners are really concerned with the mortality risk right now. So that's first and foremost. We want to make sure that if in the event owners, key employees, if they were to pass away, the business is financially protected or at least can sustain itself for an elongated period of time. So insurance, of course, has a natural play there. But now with, especially with the value of businesses being in individual estates, now with the potential change in the estate tax, we're seeing a lot of conversations come up with regard to how we can help plan for this starting now. So we're seeing combo opportunities, I'll call them combo opportunities with insurance that is business funded, but also takes care of an estate planning need, hence the endorsement split dollar piece. So I'll walk you through the case study. This is an actual case we're working on right now. I'll also explain how endorsement split dollar works. Then we'll go into why they financed it. And then I'll close out with a review of the design, some of the things that we've done with this particular case to make it fit for the client. Keep in mind that all of these cases, when we see opportunities, they're going to look different. There's not a one size fits all. So I'll kind of walk you through some of the things that we picked up in the consultation with the business owner that led us to design the case in the way that we did. So let's talk a little bit about the business. So this is a manufacturing business, second generation that we're working with. The current owner is mid 40s, got the business from their father. What's interesting here is that there's definitely a sense that this individual doesn't want to work in the business till 65 to 70. They're likely going to exit within the next 10 to 15 years. I would say they're not as passionate about the business as their parents were. We see that a lot, but in the meantime, their advisor did recognize this gap in both some of the risks that they had, right? So mortality being one, they had no key man insurance. And two, this individual, albeit he's young, his net worth is extremely high. And it's assumed that if the estate tax comes down, that he, of course, would have more exposure here. So we looked at a couple of designs, and what we landed on was, can we kill two birds with one stone? Can we use one policy to address a definite need now, but a potential need in the future? And we landed on endorsement split dollar, actually, which, as Tom mentioned earlier, is very simple. I'm going to share with you really quickly. Let's see here. Somebody give me a thumbs up if you can see this. Perfect. I got two from Neil. Perfect. So I'll share with you really quickly what we did. As a quick aside, and I'll talk about this a little bit later, Life Comp, just so you're familiar with the terminology here, is our in-house TPA. This is a third-party administrator that Lincoln or Jefferson Pilot actually purchased in the 80s. It sits within Lincoln now. It does a lot of accounting, supports CPAs with the debits and credits or any transactions that need to be entered on the books when you're doing things like split dollar, be it endorsement, loan regime, those types of things. So we provide all of this at a low cost. I'll come back to that, but I'll break it down for you real quick. And what I like to call a North Carolinaism, because I like to think in charts and graphs and very simple analogies. Think of endorsement split dollar like this. Many of you, I'm sure, have either rented a piece of property or own a piece of property that you rent to someone else. Endorsement split dollar is very similar to that. Basically, in my analogy, let's say you own a home, you have the option to live in that home or rent it to someone, right? If you decide to rent it to someone, you're giving a piece of that asset, you're lending a piece of that asset to them to use, and they're paying you rent for it. That rent to you is income. What's interesting is endorsement split dollar works the same way. The business owns a policy, it's their property, they own it in its entirety, but they can choose to take a piece of it and rent it. That's the non-technical term. They can endorse it to the insured. And for that endorsement, the insured has to pay economic benefit rates, be it table 2001, like Tom mentioned, or the annual renewable term rate if the carrier offers that. So why is this beneficial? Well, first and foremost, in the traditional setting of endorsement split dollar, we see this used a lot in conjunction with key man insurance. I always say that if you can imagine the conversation at the table, when a business owner goes to their key employee and says, hey, we love you, we value you, we would be financially harmed if you passed away, so we need to purchase life insurance in your life. If someone said that to me, I'd probably be thinking, what's in it for me, or what's about to happen to me, right? And so in a lot of cases, we use endorsement split dollar to carve off a piece of that policy to give to the key employee's family income tax free and also protect the business in one swoop. But in this particular case, we used it to help with estate tax planning. So the question with this particular business was why finance, and why finance at this point in time? Financing for me, if I break it down very simple, is a basic decision between using your debit card or using your credit card. Okay, I've got two, or using cash. I've got two options when I go pay for my gas. I can use cash that I have, or I can use my credit card. In this particular case, using credit or lending for the business made more sense because they had plans to redeploy other assets in other areas, use their money wisely to help grow profits. Even in this current environment, they were actually growing a good bit. Rates are attractive right now. They felt that if they could use their current cash, borrow for the insurance, but use their current cash for other capital expenditures, the profits that would generate from that would benefit them. So financing was used in that way. So that's a basic breakdown of why financing, a basic breakdown of the business and split dollar. Let's look at the design real quick. And it's a unique one. It's not one you're going to see every day. You maybe see it every other day. But it's unique in the fact that we were given a specific budget over a certain amount of years. And we did a 10-pay. This is why the premium looks, it's a known premium design. Premium looks a little bit weird, but we were given a specific budget to work with. And essentially what we did here was a 10-pay and ran an endorsement for 13 years. So if you can imagine here, my total face initially was 3.8 million. Of that, I took 3 million and I endorsed it to the insured, right? So to kind of reiterate what we're talking about here, in Tom's example, you could have the option if I'm over or approaching that estate tax exemption, I could have this benefit go to the trust. The trust would pay economic benefit on that. Or if I'm not in a situation where estate tax is an issue, the estate is low currently, having the 3 million won't have any adverse planning consequences, then you could have this 3 million in the estate. But 133 grand for 10 years, 1.4 million of that was retained by the employer, and the other 3 million was endorsed out to the employee. So, or the owner in this particular case. The question is, what does the owner have to pay out of pocket each year to get that 3 million income tax free? Well, they're going to pay the economic benefit rates, which for us, we use the annual renewable term rate. In year one, the actual raw cost of that is $1,200 out of pocket, of which the corporation would have bonused that to them. So their actual out of pocket cost is $384 for 3 million of coverage. So in the insurance business, we talk a lot about IRRs, internal rates of return. I would say 384 for 3 million first year is, I don't know what it is exactly, but it's high. Okay. So that's what's in it for the insured. On the business side of the ledger, right? What's unique about this particular case is that one, we didn't endorse all of the death benefit first and foremost. We did a portion of it. Part of the reasoning that we did that is because we need collateral in the policy to cover the loan, right? So if I endorsed all of the death benefit to the insured, then there'd be no death benefit there needed to collateralize our loan from the bank, which we know we need. So that was another piece of it. We're toying with a couple of designs right now where they're not sure if they want to finance the entire piece or a portion of it. It is leaning more to the entire piece. So once again, $133,333 in a 10-pay, $3 million endorsed to the estate or to the islet, still making a decision on that. But you'll see that the accumulated cost for the participant, called it the business owner or key employee, whichever your case may be, is $6,643 over that 13-year period. So it's a great way, a great planning tool that allows the business, once again, to protect itself, right? If you look at the business as a living, breathing entity, we've got key man that goes back to the business. We've got 3 million that would pay to the islet or the estate, whichever we've got designated there. And then in addition to that, what's great about this solution is that the corporation has flexibility and control completely over the policy. So what I'm showing you here can be changed at any point in time. They can extend that endorsement out. They can shorten the endorsement. Things change. I'm sure nobody ever thought we'd be in the situation like we were in 2020. Of course, this situation calls a lot of change in planning. A plan like this gives us the flexibility within certain parameters to make adjustments to the plan. So we love this solution. We do a lot of split dollar, a lot of endorsement split dollar in general. But once again, to reiterate, the current environment has led us to talk more about key person protection. And with the potential change in the estate tax, we're seeing a lot of planners get out ahead of trying to remove assets from the estate or protect against potential estate tax gaps. And so to kind of wrap this up real quick, the question is, for a solution like this, what type of support do we provide? That's where LifeComp comes in. I'm going to touch on that really quickly because I know we're up against time. From a LifeComp perspective, what we do is provide several things: accounting memorandums, physical year reports, and pretty much what we call policy reproposals. So on an annual basis, the bookkeeper, CPA, or the business itself will get accounting reports from us for the split dollar transactions. It's an accounting ledger that says this is the accounting or the economic benefit that needs to be paid this year, and it'll tell you what to debit for that amount. And that's a moving target, or can be. So we provide that on an annual basis. We also do it on a monthly if you need it. We also reevaluate the plan. One of the most important things about not only premium finance business, but business insurance in general, is that you monitor product performance in conjunction with the plan. And so our systems at Lincoln are connected to know that if a premium was different than was illustrated, or the economic benefit change based on a change that the agent or insured made, it'll adjust the accounting. So we will automatically 60 days prior to plan anniversary run an update projection, send it to the agent so that they can prepare for a conversation in that annual review with the client. So it's really one of those situations where we prepare you to be successful on an annual basis in front of the client with the plan. It really helps to increase persistency on these deals. What are you paying for it? $300 setup, $125 per policy per year. Which the former leader of LifeComp used to hate when I say this, but it's true. It's so cheap, it might as well be free. So definitely utilize it. With that said, we're coming up on time. I want to pause. I know there's a lot we've discussed today. We'll open it up for questions, but we appreciate your time.
Yeah. Thank you, Jordan. I can't emphasize enough the value of that LifeComp platform. Yeah, Lincoln is unique in that in working with split dollar programs in the past. They have a unique platform that no other carrier provides. And in any type of complicated sale, it's so important to have that backup service from the insurance company. So that's an invaluable service. I know we're running very short on time and there's many, many questions. I had a couple very quickly. Do you have a separate COLI product to your regular portfolio is my first question. And secondly, can you add MoneyGuard, which is, for those who don't know, is a long-term care policy, to a split dollar platform?
So on the first question, yeah, we do have an institutional COLI portfolio. It includes what we call single life COLI for the smaller end of the deferred comp market. There's a registered institutional product and also a private placement product for those accredited investors. I will say, though, the majority of the time, those particular products are going to be used in conjunction with a non-qualified deferred comp plan. A lot of the time when we're using insurance outside of traditional deferred comp reasons, retail is what we lean on. Our COLI division is really built for the high end of the market, Fortune 500 level institutional purchases. Sometimes they'll take the occasional case. I think the aggregate premium on a lot of those products is going to be north of $1 million for each on a 7-pay basis. On the MoneyGuard, it's something that's been entertained a lot. At the current time, we don't have the ability to integrate MoneyGuard within the split dollar platform. We do have, however, a lot of agents that look at MoneyGuard on a 162 bonus scenario, where the insurer, just like they normally would, but on the policy, and the business is expensing the premium, providing it as a compensation bonus, but expensing it as a premium, of course.
Great, thank you. Does anyone else have any questions? Is anyone baffled? It's all good stuff. Listen, this is highly technical. It's not for everyone. What I want everyone to understand is we have the resources to help you in any situation, any case. don't be afraid if you don't know everything, because none of us do. And that's why we have the LAFPN, and that's why we have company support and support of the advanced sales teams of highly educated people who specialize in very particular financing areas, as well as planning areas as split dollar and everything else. So I thank you. If there's any other questions, I don't see any in the chat box necessarily relating. But thank you so much for the presentation. I think it's very thorough and very, very thoughtful. So again, thank you.
Great presentation.
Have a good day, everybody.
Have a wonderful
all.
day. And
Thank you,
again,
Drew.
good to
Yeah,
see everybody.
Thank you.
Have a great week, everybody. Bye-bye.
You too. Thanks again.
They're all. Bye.